Good afternoon, everyone, and a warm welcome to Carry Asset Management quarterly webinar. We're thrilled to have so many of us join us today. The theme of today's session is Q1 2025 Nigerians Economic Scorecard, a new dawn or a circus. My name is Folake Osho, and I have the pleasure of moderating today's webinar. At Carry Asset Management, we're driven by our mission to create exceptional wealth for our stakeholders. And in order for us to fulfill our purpose of transforming lives through the power of wealth creation, this webinar is one of the many ways we are committed to keeping you informed, empowered, with valuable insights on market trends, economic development, and strategic investment decisions. We would also like to take a moment to express our sincere appreciation for all our key partners, stakeholders, and special guests for being here today. So just before we get right into the webinar, I would like to do a quick webinar outline just to ensure we maximize our time together. So here's a quick overview of today's session, which is basically the webinar dynamics. So our esteemed guest speaker, Mr. Johnson Chukwu, will deliver a 40-minute presentation on the Nigerian economy. And there will also have an interactive Q&A session. So we encourage everyone to participate. You can submit your questions via the chat box, or you can also request a live question during the question and answer session. Each live question will be limited to a minute or a minute and a half, just to ensure we accommodate as many questions as possible. This webinar is streamed live across Facebook, Instagram, and other social media platforms. Please use the handles showing on your slides and your screens. Also note that the presentation slides will be emailed to your registered addresses after the session. A record of the webinar will also be available on demand viewing on our YouTube channel. If you have further inquiries or questions about our services and products, please feel free to reach out to our team at info@carryasset.com. So I'll move to the next phase, which is introducing our esteemed speaker. Without further delay, let's just dive right in. Ladies and gentlemen, distinguished guests and stakeholders, please welcome our Group Managing Director, Mr. Johnson Chukwu. Mr. Chukwu brings over 3 decades of invaluable experience across multiple sectors in the Nigerian economy, capital markets, the banking sector, oil and gas, and many more. He's a fellow of both the Institute of Chartered Accountants of Nigeria and the Chartered Institute of Taxation. He has enhanced his expertise through prestigious program in Harvard Business School and Stanford University. He's also a highly respected voice in the media. Mr. Chukwu regularly provides commentary on capital markets, the banking industry, and the broader economic environment. Today, he will provide us a comprehensive overview of the current state of both global and local economies and what we should expect in the coming months. We're truly honored to have you here today, sir. Thank you so much for joining us, sir.
Good afternoon, everyone. For those of us in Nigeria, and good morning to those of you in the Western world. Thank you, Folake, for that introduction.
Okay, so we can't hear you.
Can you hear me now?
Hear you. Oh, okay.
Can you hear me now? Can you hear me?
Yes, I can hear you. Positive, sir.
Okay. So I can proceed. Okay, good afternoon once again. Our distinguished guests and participants. Once again, thank you for joining us in this webinar, which we have made a compulsory or a regular quarterly outlook. Aside from this one, we're going to modify the format of the presentation, and it's going to be, to some extent, physical and some virtual. So going forward, it will now be quarterly economic discourse, carry quarterly economic discourse, where we have a presentation. It could be by me or any of my colleagues or any of the outstanding knowledge economists in the country or anywhere in the world. And then we'll also have discussants, and then we'll have audience participation, as well as those that will join virtually. So, but having said that, I'll go straight to this week's, this quarter's presentation. I will share my slide immediately, and then I will just give me a second to share the slide. Just give me a second to share the slide. Folake, can you confirm if you can see my slide?
Yes, I can see your slide.
Okay, good. So today we'll be discussing on Nigeria's Q1 economic scorecard, a new dawn or a circus. And why did we say a new dawn, a circus? When we looked at the first quarter performance of the economy, it looked like we started well in the first quarter of this year. But unfortunately for the country, a couple of things have happened at the beginning of the second quarter of this year, with what Mr. Donald Trump, the US president, called the Liberation Day. And that has completely brought back our vulnerabilities to the fore. So first of all, we'll start by looking at the executive summary, the outlook. So we just go straight to the executive summary. At the global level, the economy in Q1 2025 followed the sporadic, witnessed sporadic economic policies and political pronouncement by Mr. Donald Trump, the US president, on assumption of office for the second time. So the global economy was to a reasonable extent shaped by the pronouncements that were made by the US president. Growth momentum across advanced economies slowed down marginally, and because of the concerns of the threat of tariff. Of course, we know right from February he had mentioned that he was going to impose 25% tariff on Canada and Mexico, which after some border arrangement by the countries to restrict inflow of what they call illegal immigrants to the US, he had to suspend that. But there had been consistent threats. There was a threat against importation of any country that imports Venezuelan oil. He had made threats, and the threats had on and on until the final pronouncement of tariff across the world. So that slowed down economic momentum in the first quarter of this year. IMF had actually predicted that the global economy would grow at 3.3% in both 2025 and 2026, and the inflation to moderate to 4.2% in 2025 and 3.5% in 2026. Interestingly, U.S. economy, economic inflation actually moderated to about 2.4% in March. But everything after that moderation has turned south. And it is very likely that by the time they come out with a April inflation print, it will be higher than 2.4%. So what we say, the global inflation, particularly the U.S., is higher, expected to move northwards in response to the tariff war between U.S. and China, as well as concerns on the possible activation of the import duties imposed by the U.S. government on all economies after the 30-day suspension. We know that the minimum tariff the U.S. government imposed on any country is 10%. Nigeria's own is 14%, and several other countries have tariffs above Nigeria's tariff rate. But what we're just saying is that suspension by 90 days, which we are beginning based on what is going on, to wonder if he will have the courage to lift it or to restore those sanctions. As it stands today, the tariff war is now basically between the US and China, because China aggressively retaliated, stood up to what we may consider as a bully. On the Nigerian side, Nigerian economy is expected to actually maintain steady growth in Q1 2024. We don't have the figure for Q1 2024, but from all the feelers we have in the market on the economy, we expect that growth rate would remain strong or relatively better than what it was same quarter last year. Bear in mind that in Q1 2024, the GDP grew at 2.98%. It grew at 3.19% in Q2 2024, at 3.46% in Q3, and then at 3.84% in Q4, eventually averaging about 3.4% in 2024. The exchange rate remained relatively stable in Q1 2024, with Naira opening the year at official window of 1,538 Naira to a dollar and closing at 1,536 Naira to a dollar. That was actually a marginal 2 Naira gain at official window. The last trading day last month was on 28th of March. Bear in mind that 30th of March and 1st of April, sorry, 31st of March and 1st of April were public holidays in the country. The local currency appreciated marginally the parallel market rate from an opening rate of 1,670 Naira to the dollar at the parallel market rate to close at 1,560 Naira to a dollar at the end of March. Inflation also moderated in the first 2 months of January and February 2025. Bear in mind that March inflation figure was yet to be released as of today. The inflation rate in January was 24.48%, and in February, it was 23.18%. But it must be stated that these were based on a new base, a rebased 2024 figure, which used the average inflation rate of 33.18% as the base. So if you consider that, you will realize that if you use year on year and you look at inflation in 2024, inflation in February 2025, you will observe that average prices had actually increased by 66%, 66.36% in the between February this year and the entire period of last year. That's 66%, which is why a lot of households are still feeling the pinch, because if your income has not increased in the last 14 months by 66%, then you are likely going to see a worsening in your standard of living over that period. And that's why some people ask us that we don't understand why you say that inflation has moderated. But when your income has not improved by 66.36%, you are certainly in a worse situation than you were as of February 2024. Then looking at the global economy, we have to segment the global economy into 2 periods. Prior to the Liberation Day, which was the entire first quarter of this year, and what happened after the Liberation Day, because a lot of things have happened after the Liberation Day. And it seemed that what happened after the Liberation Day completely upturned whatever gains that were made in the first quarter of this year, the first 3 months of this year. In terms of the global economy, in the first quarter of this year, the global economy navigated a complex mix of macroeconomic headwinds and geopolitical development. Growth momentum across most major advanced economies shows signs of deceleration. I had actually mentioned that in the summary, primarily due to lingering inflationary pressure, tighter monetary policy, and renewed trade frictions that put people on the edge, that dampened investor confidence in that quarter. Then we saw the IMF projecting that the global economy will grow at 3.3%. That projection, we believe they will revise, given what is happening to in the world economy today. Then if you look at trade, we saw a rebound in trade, global trade, driven by investment in digital technologies, as well as green energy, which boosted economic activities in the quarter. Across the regions, we saw the Middle East and North African countries, like the MENA region, grow at 2.9%, short of their projected 3.4%. We saw that growth driven largely by tourism, finance, and technology. Then Sub-Saharan Africa, our economy grew at 3.6%. Bear in mind that we had mentioned that Nigerian economy grew at 3.4%. And Nigerian economy is the second biggest economy in Africa, which means growing at 3.4% when the African economies grew at 3.6% simply means we actually dragged down the growth in the African economies because of the size of our own economy. So if you look at the table on your right, you see global economy growing at 3.2%. It's expected to grow, that for last year, it's expected to grow at 3.3% this year. But last year, 2024, the global economy grew at 3.2%. United States grew at 2.5%. China grew at 5.4%. India at 6.2%. India has remained the fastest or the strongest growing major economy in the world as at last year and has largely sustained that growth. Brazil at 3.6%, the rest of Southern Africa at 3.6%, and Nigeria at 3.4%. You saw that Germany was among the few economies that contracted last year. And because of the German contraction, the Eurozone grew at only 1.2%. Bear in mind, the German economy is the biggest economy in Europe, in the European Union. So if you look at a snapshot of what happened in the economies, we talked about the growth of 2.5% in US, driven largely by consumers, low consumer spending, as well as, though we saw a slowdown in labor market. And then if you look at China, China's growth was largely driven by stimulus from government stimulus targeted at infrastructure, as well as manufacturing activities. Although demand remained weak, as well as the concerns of rising debts, particularly as it relates to the real estate sector. These are challenges that the Chinese economy has sustained, which led to a growth of 5.4%. The Eurozone growth was largely weighed down by Germany, that contracted, particularly coming from the manufacturing sector of the German economy. The emerging markets, we talked about the growth in Sub-Saharan Africa of 3.6%, Nigeria 3.4%, but emerging markets as a whole was largely driven by the growth in India at 6.2%. United Kingdom saw a weak growth, but positive growth, driven largely by lower food prices and lower energy prices. So looking at inflation rate moderated last year, down to 4.3%, from a 6.7% in 2023. And if you look at the major economies whose inflation rate moderated, as at end of March, US had an inflation rate of 2.4%, which is quite comparable to its target rate of 2%. China's CPI, consumer price index, was largely zero at negative of 0.1%, which means China is witnessing a deflation. So that people now understand, it's actually when prices are turning negative, prices are declining. The prices are declining. That's what you call deflation. And that's what China is witnessing. And we always have a saying that a deflation is not really a good thing for an economy. India's inflation was at 3.6% in February. UK inflation moved northward again to 2.8% in February, and Japan at 3.7%, Germany at 2.2%. Of course, Nigeria, our inflation rate was at 23.18%, very close to Ghana's 22% in March. So believing that by the time we get the March figures, we will be in the same region with Ghana. But all those things are prior to the Liberation Day. So let's look at the new world order that are being created by Mr. Donald Trump. Well, since he came into power, he had made a raft of policy pronouncements. On January 20th, on the day he was sworn in, he signed a number of executive bills, declaring a national emergency at the southern border and directed deployment of military forces, as well as homeland security. And also initiating the construction of physical barriers, fence off the Mexicans. The administration has also joined its catch and release policy and now reinstated the Remain in Mexico program and intensified deportation, claiming to target individuals with criminal records. On trade and economic policies, I had mentioned earlier he announced a 25% tariff on Mexico and Canada. And the key thing is that these are the closest countries in terms of proximity to the US border. But not only that, Canada has always been a major ally of the US for decades. And then increased the tariff on China, but subsequently he suspended the tariff on Mexico and Canada on the basis that they have taken some measures to strengthen their border. And I had mentioned earlier he had imposed a 25% tariff on any country importing or buying Venezuelan oil, hoping that this will bring the Mudrock regime to its knees. And then on foreign policies, he signed an executive order and initiating a 90-day pause on U.S. foreign development assistance programs, and saying that they need to conduct a comprehensive review, but support or military assistance, food and military assistance to Egypt and Israel were not affected. And then he had withdrawn from the climate agreement through order 14162, which was also signed on the day he assumed office. And then at the domestic end, the administration has implemented a policy aimed at downsizing federal agencies, including significant changes to the Department of Education and the USAID, as well as the government intends to fund or to support artificial intelligence development, believing that the US should be in a vault position, should be at the commanding height of development in artificial intelligence. Now, but beyond that, those were the initial measures he took. On 2nd of April, he announced the Liberation Day and imposed tariff across every country, what he called reciprocal tariff. And this, we have highlighted here the countries that the US is suffering the worst form of balance of trade, and which he imposed severe tariffs on. You can see the China at 295 billion, European Union at 236 billion, Mexico at 172 billion, Vietnam at 123 billion, Ireland at 87 billion, Germany at 85 billion, Taiwan at 74 billion, Japan 68 billion, South Korea 66 billion, and Canada 63 billion, and India 46 billion. These are the US major trading partners. It actually has a positive balance of trade with the United Kingdom. These are the countries that took the brunt of the tariff announcement. Today, the tariff rate had increased to I think around 54% for against China, and China has imposed a 125% tariff on the US. The US also announced tariff across the entire countries listed here. In fact, every country in the world, although it has suspended that tariff. We'll come back to the real reason why it suspended the tariff, which is how the global market had reacted. Of course, we saw almost virtually every bourse, every capital market, take a hit as a result of these tariffs. We can see the Dow Jones Industrial Average, the S&P 500, the Nasdaq Composite, the Russell 2000, the Asian market, the European market, all we are in the negative territory as a result of this pronouncement. But beyond the impact on the capital market, remember that Donald Trump said he wasn't going to reverse back down on those on the tariff. But some other factors hit home, which included a spike in the yield on U.S. bond instruments as well as U.S. Treasury instruments, which could signpost a dumping of those bonds and debt instruments by investors. There's a report that said that Canada owns about 350 billion of was holding about 350 billion of U.S. Treasury instruments or debt instruments. The European Union about 1.5 billion. 1.5 trillion of U.S. Treasury instruments. Japan and most other countries, and those countries agreed. Well, that's the feelers we had, that they agreed to begin to gradually dump the U.S. instruments. What that means is that U.S. will now have to pay, because U.S. government is a major borrower. They have to pay much higher interest rate on their debt instruments as the price of these instruments collapse and yield go up. Not only that, borrowing by corporate organizations in the U.S. are going to be very steep, which means productive activities in the U.S. is going to slow down, and slow down possibly to a recession. There are also projection that the tariff will push the world into a recession, but we believe that the U.S. will be the first to suffer a recession in case interest rates go up materially, and the U.S. has to pay a lot more for debt service, and then U.S. corporates also have to pay a lot more to borrow. And they are not, remember that one of the motives of this tariff is to onshore production activities back to the U.S. But for you to onshore production activities back to the U.S., you need to make U.S. a cost-competitive economy. And higher interest rate would make the U.S. to be less cost-competitive. And so so Donald Trump, despite his claim that he was going to back down, was the first to back down. Had to back down from his tariff, and then claimed that he was going to suspend it for 90 days. I personally feel that he's not going to restore those tariffs. He's going to go into deeper negotiation with those countries, which was the right thing to do. But unfortunately, this has already triggered a major concern by countries that we are considered as permanent allies of the U.S. And who are now going to review their position as it relates to their holding of U.S. bond instruments. Not only the stock market was affected, and not only fixed income instruments, the U.S. Treasury bonds and U.S. Treasury bills were affected. You can look at the slide here. You can see what has happened to the crude prices as well as gold prices. Crude prices have dropped to as low as $64.76 as at 11th of April, which was the last Friday when we last collected data. And you can see flight to safety. As people are selling off stocks, selling off bonds, they are investing in gold. You can see the spike in gold price. Gold price started this year at $2,669 per ounce. It's now around $3,244 per ounce. So you can see that the gold price is the beneficiary of the flight to safety that we're dealing with. Now, breaking it down home, because the questions that people have always asked that, what will be the impact of the trade war on Nigeria? And we started by looking at, we want to look at the trade between Nigeria and the US. If you look at the trade between Nigeria and US in Naira terms, remember that 2024 had Naira adjustment, exchange rate adjustment. So you see sorry, this is actually in dollars. It's not in Naira. You can see our total export to US was $5.5 billion in 2024, and our total import from US was about $4 billion. I'll correct that sign to indicate dollars. But now compare that to China. Our total export to China last year was $2.9 billion. Our total import from China was $14 billion last year. And so that will show you who has more impact on Nigeria. In terms of share of Nigeria's import and export, last year, the US share of Nigeria's export was 7.3%. US share of Nigeria's import was 6.7% entire of last year. But now, looking at China, China's share of Nigeria's export was only 3.9%, but China's share of Nigeria's import was 23.3%. So if these are to be compartmentalized, the economy that will affect Nigeria most is China, in terms of if there is increase in cost of production as a result of the tariffs. But good thing, China is not imposing tariffs on imports from other countries. So if US imposes tariff on import from other countries, and those imports serve as input materials to their production activities, then it will affect the cost of our import. Remember that most of our import from US are like the likes of machinery that we import from US. But in terms of export to US, our export to US was largely insulated based on the pronouncement made by Donald Trump that energy input materials, which includes crude oil, will not be affected. So in effect, we should expect that our export to US will remain largely what it was last year, assuming all things being equal. But that is very simplistic, because if you look further than that, and you consider that everything I've said here could mean that the US economic productive activities or GDP will slow down. So if there's a slowdown, that means there'll be a slowdown in demand for input materials, which means there'll be a slowdown in demand for crude, which is why we have seen a consistent decline in crude prices. In fact, we saw the crude price drop below $60 during the past few days, all as a result of this trade war. So does it affect Nigeria? Yes. How would it affect Nigeria? We saw the drop in crude price. But we'll come back when we go to the vulnerabilities of the Nigerian economy, which is why we talked about Circus. Then looking at the Nigerian economy performance in Q1 2024, we saw, if you look at even last year, we saw consistent improvement in GDP growth rate, 2.98%. I mentioned that in first quarter of last year to close at 3.84% last quarter of last year, and the average of 3.4% in the entire year. This was driven largely by non-oil sector. In terms of the GDP per annum, the last year's GDP performance was only the comparable to what we achieved in 2021, where we are coming from a recession. 2021 GDP was at 3.4%, which is what we equaled last year. Prior to that, the GDP had been below that level. But bear in mind that our population is growing at 2.4%. So if you take a population of growing at 2.4%, the positive improvement in net economic activity is just 1%, because the GDP grew at 3.4% last year. Now, if you look at the growth was largely in the financial service sector, telecommunication sector in particular, and then as well as the real estate sector. These are the share of the sectors, the key and their contribution to the GDP. If you look at the agriculture sector, which accounts for almost 25% of the GDP, grew by only 1.19%. You saw the ICT sector growing at 5.4% and accounting for almost 18% of the GDP. Trade grew by only 0.9% and accounted for 15% of the GDP last year. Manufacturing grew at 1.38%, accounted for 8.6% of GDP. Financial sector grew at 15.6%, one of the strongest growths, or one of the strongest major contributory growths, and account for about 6% of the GDP. You have the mining and quarry, where you have the oil and gas sector. It accounts for 5.64% of the GDP and grew by 4.4%. And the real estate sector is actually coming on strong. Grew at 13.3%, accounts for 5.4% of the GDP. So this pie chart basically reflects what I just saw in that table. Okay, I had mentioned the inflation rate. We've seen inflation moderate month on month for 2 consecutive months, from 24.48% to 23.18% in February. Bear in mind that the moderation in inflation was largely driven by the base effect. Of course, there is actually some level of moderation, but the base effect had the most pronounced impact on the lower inflation rates we are recording currently. Then we've seen, with the moderation in inflation rate, we've seen the net interest, real positive interest income for those who are investing in debt instruments and fixed income instruments. Remember that MPR rate is at about 27.5%, and we saw inflation rate in February at 23.18%, which gives you, if you use the MPR as a benchmark rate, that means we have a positive net interest return of 4.3%. It was 3.02% in January. So now let's look at what are those factors that should, one of those two that should ordinarily shape economic performance in 2025. We have a budget of 54.99 trillion naira for this year, which is predicated on a revenue of 41.91 trillion. Of that revenue, we expect oil to give us 19.6 trillion, and we expect non-oil revenue sources to give us 22.31 trillion. But bear in mind that the expectation of 19.6 trillion naira from oil is predicated on a crude oil average production of 2 million barrels a day, up from about 1.78 million we had projected last year. And currently we are doing about 1.4 million barrels. We had also projected that crude price would be at $75 per barrel. Currently, we're doing about $54 per barrel. That is more than $10 shy of our budget target. And the government projecting an inflation rate of 15.75%. So that's why we say this is a very ambitious budget. And we are planning to spend 14 trillion on debt service, which is actually a non-discretionary expense. The recurrent expenditure of 13 trillion is also largely non-discretionary, and that includes salaries and wages. So if you add those two, you are already at 28 trillion, almost 28 trillion naira as what you call non-discretionary expense. So for us to even spend a dime or a kobo on capital expenditure that is not that, and that expenditure is not borrowed, means that we must generate revenues above 28 to 30 trillion naira before we have any headroom to spend. So what that means is that if the budget revenue is not achieved, then it becomes difficult for government to effectively implement the capital expenditure component of the budget, unless we have to go into massive borrowing. To really understand this, government had actually, based on this projection, had planned a 13 trillion naira borrowing. So if, like I said, if we don't achieve a 41 or 42 trillion naira in revenue, then we have to borrow above 13 trillion naira, which is exactly what we have, what we did last year. If you look at last year's budget, the government recorded a deficit of 13 trillion naira last year. The total revenue last year was only 7.8 trillion naira based on the report from Central Bank, while expenditure was 21 trillion naira. So you can understand, if you made the budget a total revenue of 7.8 trillion naira last year, we're already planning to do 41 trillion naira this year. And that's, for us, is extremely ambitious. And the assumptions are also almost unattainable. Crude oil price at $75 per barrel is looking like a tall order. Crude production about 2 million barrels a day ab initio was extremely very optimistic. And the problem is that when you do not meet the budget revenue, you are bound to borrow more, which is why we saw our debt stock increase to 144 trillion naira in 2024, up from 97.3 trillion naira in 2025. Basically reflecting the impact of depreciation of local currency as well as additional borrowing by government to meet budget deficit. Like I said here, that we borrowed 13.3 trillion, the budget deficit of 13.3 trillion last year. External debt service, external debt comprised about 48% of our total debt, well as local debt considered about 51% of total debt. If you look at the pie chart in the middle, it would show you the distribution of our total external debt, with multilateral agencies accounting for 48% of our total debt of $22 billion, bilateral partners largely dominated by China account for 13.3% of our total debt of $5 billion of our total debt. And then you have our commercial borrowing, which are largely Eurobonds, which account for about Eurobond accounts for about 12% of our total debt, 0.2% of our total debt. Sorry, 12% of total debt. Okay, so now moving to the external sector, which we said the external sector actually shone brightly in Q1 2025. If you look at our trade surplus, Nigeria had a trade surplus if you, based on the report from the Bureau of Nigerian Bureau of Statistics, Nigeria had a trade surplus of 16.85 trillion naira, up from about 5.1 trillion naira. We saw our export at 77 trillion naira and our import at 60 trillion naira, which gave you a total trade of 138 trillion naira in last year. Part of the jump you saw in the naira value of our trade was because of naira depreciation. Because if you look at our trade, total trade in 2023 was only 66 trillion naira. So it's not as if our volumes, in terms of actual volumes, actually doubled, which is what this naira value impression gives. Now, looking at our total major exports, our major exports, crude oil and oil-related products still account for 88% of our total exports, which is part of the vulnerabilities we'll be discussing as we move forward in this conversation. Then you have your beverage and spirit and tobacco, about 3.9% of our total exports. And then you have vegetables, which are largely agricultural products, which is what will be affected if Donald Trump imposes the 14% tariff. It accounts for about 2% of total export. That's agricultural products that we export to other countries, account for about 2% of total export. Chemicals, about 1.7%. Vehicles, aircraft parts that are re-exported to other countries account for 1.2%. And other export commodities account for 2% of total exports. So you can see that our total export is largely, our export is largely still petroleum and oil and mineral products. And then if you look at our imports, you see our fuel, which is fuel and AGO and ATGO and other petroleum products account for 38% of our total imports. Machinery and appliances, partly coming from US, partly coming from Western countries and China, account for 16% of our total imports. Chemicals, 8.8% of total imports, mostly from countries like India. Vehicles, aircraft parts, and other vessels account for 7.5% of total imports. Plastics, rubber, and articles account for 5.7% of total import, and other items about 20% of total import. In terms of share of our total imports, China accounts for 27.8% of our total imports, followed by India, 11% of our total imports. Then you can actually say that the Asian countries, the two Asian countries, account for over 39% of our total import, almost 40% of our total import. By the time you add Vietnam and some other countries, Asia accounts for almost half of our total imports. And then you have Belgium accounting for 8% of total imports, United States 6.3% of our total imports. That was these are figures based on Q3 2024. And then you have our total imports. Our exports are going largely to Netherlands, France, Spain, India, and Indonesia. These are our major trading partners. So you can see on US is featuring on imports, but it's no longer featuring on export. It used to be a major export market for our crude. Part of the positive we saw in our external factor includes an increase in capital importation, which increased to 7.23% in the first 9 months of last year. Of course, most of the capital importation is portfolio investment, which is actually what drove capital importation last year, principally because of the increase in yield on federal government debt instruments, treasury bills, OMO instruments that incentivize investors, foreign investors to take up positions in our in Naira as instruments. If you look at the graph there, you will see consistent decline in our capital importation from a peak in 2019 of 23 billion. We have consistent decline. Last year, 2023 was one of the worst, where we bottomed out at 2.8 billion. But like I said, we saw a resurgence last year up to the 9 months of last year, 7.2 billion. But bear in mind that this was mostly portfolio investment. Reserve, we also saw our foreign exchange reserve peak at about 40 billion and then dropped about 38 billion in the quarter last year. And then, of course, we also seen major fluctuation in crude prices, which had worsened after the Liberation Day pronouncement by Donald Trump. So I had mentioned earlier that we saw a marginal, the exchange rate remained lightly stable in the first quarter of this year, but that has changed in the second quarter of this year. I had mentioned that the parallel market opened at 1670, 1,670 naira to $1, and closed as at the end of March at 1,560 naira to $1. At the official, that appreciating by 4%, almost 4.5%. At the official window, it opened at 1,538 naira, 25 kobo to $1, and closed on 1,536 naira, 82 kobo to $1, gaining almost 2 naira at the official window. So now looking at domestic equities, we saw the equity market gain only 2.6% in the first quarter of this year. The equity market, the first 2 months of the year, the equity market gained 1.52%, 3.18%, and suffered a loss in the third month of the quarter. So overall, the market had gained 2.6%. Of course, with no market activities, volume had been remained strong, but investors have been very circumspect in taking equity risk, given the level of volatility we are seeing in the global market, Nigerian equities market. This is despite part of the constraint that investors have actually observed, that in terms of dividend yield, the declaration of dividend by major quoted companies have not been to the expectation of investors. We saw dividend yield that we are far shy of the expectation of investors. So in terms of a breakdown of the sectorial performance, we saw the Nigerian consumer goods sector gain 4.46% in the first quarter of this year, and the banking sector leading the gainers, probably because of the expectations of higher return. The banking sector lead performance was driven by GITCO, Wema Bank, and Fidelity Bank, whose stock prices remained quite strong. And then the consumer goods performance was driven by the likes of Chelarem, Livestock Feeds, Northern Nigerian Flour Mills, and Honeywell Flour. Then we saw the oil and gas sector suffer major losses, sectorial loss of 9.32%, and then followed by the industrial goods sector as well as the insurance sector. The losses in the oil and gas sector was driven by sell-off in Orlando, or Aradel and MRS Oil. For the industrial goods, it was cement and Julius Berger that drove, as well as that dragged down the market, despite the gains by Lafarge Africa. And the insurance companies, Sunu Assurance and Veritas Capital and Gain Insurance, dragged down the market. So the table there shows the top gainers and the top losers, or what we call the gainers and the laggers in the first quarter of this year. Then looking at the fixed income market, you can see the bond yield. We are seeing a compression in bond yield. We're seeing a kind of reduction in bond yield, with even the central bank pulling out, withdrawing the 10-year bond from further from reissuance. probably because of the expectation that interest rates are going to moderate in the near future. But like we said, some of these things have been upturned by the announcement of February 2nd. I'm sorry, March 2nd. The same thing happened in the bond yield. We saw the bond yield, federal government bond yield, Euro bond yields slow down to 9.64% at the end of the quarter. But unfortunately, that has also reversed. So that's why I said we now have 2 periods prior the declaration of freedom, or whatever I called it, and post the Freedom Day declaration. Virtually all the debt instruments, which were said that the outlook, the performance of the economy in the first quarter of this year was quite good, which the summary had captured. We saw even yield on treasury bills moderate towards the end of the first quarter. You saw the federal government treasury bill yield averaging 18.71% at the end of the quarter, from a high of 18.81%. Bear in mind that it had actually gone as high as 19.8% at the end of last year, and as high as 19.77% in January. But we saw a trough. It came down to about 17.52% and went up again when the pressures on FS came back, and the central bank has to increase yield to retain foreign investors' portfolio interest in the economy, or to attract more risk voracious investors. The same trend actually also manifested in the OMO market, with trade moderating after peaking at 23.8%. So now looking at Nigeria's fiscal vulnerability remains unresolved, which we say why we had to put the question: is it a new dawn or a Circus? Ordinarily, what we saw in the first quarter of the year should have told us that we are now in the new dawn, which is the excitement we had. But when we interrogated the figures post the Freedom Day, we now realize that the vulnerabilities we are still there, and that they all have come to the fore again. If you look at the external reserve, you can see external reserve was at 38.31%. It has consistently declined. We're now at about 38%, because the central bank has to use up to $300 million to support the exchange rate. In spite of that effort to support the exchange rate, we also seen Naira give way. Naira has, if you look at the graph to your right, these are symptomatics of the vulnerabilities of the economy, because crude prices have dropped. If you look at if you look at, okay, we don't have that graph here. I would have shown it to you, that crude price have, which I think I showed earlier, that crude price have actually tapered down to about $64 per barrel over the past few days. And that reduction in crude price meant that investors became worried about the sustainability of the exchange rate. The exchange rate gave in to as high as 1620 at the parallel and official market windows. And the central bank has been quite strong in trying to defend the Naira, or to support foreign portfolio investors that are exiting. And that has put pressure on the exchange rate, and as well as put pressure on the reserve. To put this into context, if the exchange rate depreciates, what happens is that it will pass through effect of reflecting the inflation rate. So the inflation rate we are seeing moderating at 23.18% may reverse. And they're all driven by the impact of crude. We had shown to you all here that crude account for 88% of our total exports. So crude price had dropped, and crude volume had dropped. Crude volume had dropped about 1.4 million barrels a day, from about 1.54 million barrels a day we had average last year. So these things are symptomatic of the weaknesses of the economy, and what could be that. JP Morgan gave out information to its investors on the likely direction of exchange rates of inflation rate, of commodity prices based on the tariff war. Yes, so you can see the crude price, the crude volume production in January were 1.54 million barrels a day, dropped to 1.47 million barrels a day, and had further dropped to 1.4 million barrels a day, which are symptomatic of the vulnerabilities of the economy, that when you think that things are turning positive, it looks like some other factors, sometimes exogenous, will hit us and set us back backwards. So now, what are the expectations? These expectations must be taken with some level of reserve, because these expectations we are based on the fact that we're going to have a smooth sail in the global economy. We think if there are no major distortions, which we doubt if there won't be any major distortion, because we think the variables are stacking up to a major trade war that could affect every country in the globe. We think investors will come back to the equities market in the first half, at the end of the first half of this year. We think for those investors, you need to talk to our analysts, as well as our traders and your relationship managers. If you don't have a relation with Carly, I think it's time for you to do that, so that we can guide you, because these variables are so volatile now that you need to be, every day we review our recommendation list, because the variables are moving at that rate. But as I speak today, on the banking sector, we have the GITCO, the UBA, Zenith Bank, Fidelity, and Access Corp. In the consumer goods, we are recommending Guinness, Unilever, and UAC. In the oil and gas sector, we will trade very cautiously, and I repeat, very cautiously on the oil and gas sector, given what's happening in crude prices, as the volatility even in the downstream sector of that industry. Seplat and Aradela in the upstream sector, crude prices will be a major challenge, but we always have advise, talk to your investment advisors before you go in. But for now, these are the stocks: Seplat, Aradela, and Etana PLC. Then at the telco sector, we have a strong bet on MTN for the medium to long-term investors, and Airtel. In the agriculture sector, we have no reservation in recommending Okumu Oil, Livestock Feed, and Honeywell. And in the industrial goods sector, we ask you to trade cautiously, because this sector will be driven by government expenditure, which could be hampered by revenue constraints. But as we speak today, we can relatively recommend UPDC, Dangote Cement, and WAPCO. Like I said, every recommendation is subject to review on a daily basis. So talk to us. If you already have an account, take this opportunity to open an account with us. Then, as it relates to the money market policy, we think Central Bank, we play the money market its money market policy in tandem with movement in exchange and demand for forex. If the demand intensifies and they see exit of investors, they are going to increase the yield to attract very high voracious risk investor with voracious risk appetite. But if there's no strong exit of foreign portfolio investors, or if the exit slows down, we will see treasury bills in the range of 22 to 23%. On that note, please bear in mind that the economy started the first quarter of this year on a very strong positives, but the tariff war is likely to bring to the fore the economy's vulnerabilities and vitiate the gains made in Q1 2025. Thank you all.
Thank you very much, sir. Thank you very much, Mr. Chiku, for such a thought-provoking and insightful presentation. You have taken us on a well-rounded journey, reflecting on the key economic impacts. You've also painted a very vivid picture of what lies ahead in the coming quarters. Just to be sure I'm being heard.
Yes, you are being heard. Go ahead.
Okay. So I just want to thank you for your deep dive into the policy dynamics. the sectorial performance that you've highlighted for us and just the macroeconomic trends that you have not only shielded light on, you've also been able to put also opportunities and challenges that lie ahead. It is also very clear that decisions that are being made at policy level are having significant impact on Nigeria's economic trajectory and opening doors for strategic growth too. So we will now move into the interactive part of today's session, which is the Q&A segment. I will just call. Okay. Oh, okay. So we'll move to the question and answer segments. Okay, so the first question is from Ezekiel. It says, please, would the slides be sent to participants? Yes. Okay, so the next is from Anonymous. Do you see the massive market sell-off in the global equities markets as overreaction or not to the trade war between US and China? Then another question from Michael Oguna said, thank you, doctor. I'm surprised that you did not recommend any of the banks, even Access Bank, that has gone down in price. So we'll take two questions, sir, at a time.
Okay, thank you. The first thing is that I do not think the market is overreacting. The impact, the import of the trade war could be very strong. And they say the first to jump out is always the person who is safer when there's going to be a stampede. But the key thing is that I was very certain that Mr. Donald Trump will blink first, because I do not think that we are very detailed in the analysis of how the world will react. It's biggest logic that anybody will start a trade war with every country in the world, every country. So with that, the entire world responding will certainly compel him to back down, which is what he did. He's still backing down more and more. I'm sure you're aware that he has now exempted telecommunication, phones, computers from any tariff. Simple reason that the likes of Apple has taken huge beating because Apple is producing from every part of the world. So it simply means Apple can no longer ship conveniently to the US, and Apple stock took a huge dive. So, and today he's now discussing that he will also exempt vehicles and auto from the tariff. So he's backing down and backing down and backing down. But before that, it was the investors actually knew that the policies, the tariff war that he had triggered will certainly bring the global economy into a recession, because the global economy is far more connected than it was in 1929, 1934 than now than it was then. So those people who were exiting, we are just taking a safe position. So I don't think they were overreacting. They overreacted. Now to the second question. We did recommend some banks. We recommended JITCO in my presentation. We recommended Access Corp. We recommended UBA. So we recommended about 4 banks. We recommended Fidelity Bank in that recommendation. We felt that given some of their prices, they have opened up an entry. We are trading at entry prices that we think are good entry points. So we did recommend some banks.
Okay, so we have another question from Samuel. He said, many commentators are of the opinion that the fall in confidence regarding the US economy and dollar gives a good case for de-dollarization and opportunity for adoption of European euro, Chinese renminbi among others as suitable alternative reserve currencies. What's your view on this?
Well, interestingly, the Chinese government is already trying to bypass the SWIFT payment system by creating a direct settlement of renminbi with other countries. And they are testing that, and it looks like it's going to work. Also, bear in mind that the countries that we are, the emerging economies of the BRIC countries, we are also already considering alternative to the US currency. But it's not as simple as that. To decouple from the US currency as a medium of global trade will take quite some time. What I think may actually disrupt dollar as a global medium of trade is digital currencies. And I think the Chinese digital currency, which they have adopted, may be a forebearer, a forerunner to the world adopting digital currencies that will bypass the US. But the most important thing is the US, the measures taken by Donald Trump will eventually, in a matter of years, diminish the relevance of US as a global economic power and elevate other sub-regions, other economies to more pronounced, prominent positions. And I think that's what they did not contend with. I think there's a Chinwendo who said he has been raised his hand. Can we give him access?
Yes, please. Please go ahead. Can you unmute yourself, please, Mr. Chiwendu? If you're speaking, we can't hear you. You're still muted.
Can you hear me now?
Yes, better.
Oh, thank you. Thank you very much. Thank you for your insights, Dr. Johnson Chukwu. I didn't see an outlook as to where the exchange rates and the reserves will be at. I didn't see that in your outlook. Maybe I must have missed it. Then secondly, the CBN has insisted that, has said Nigeria needs FDIs and has said that banking recapitalization must go on despite Trump's sweeping tariffs. Do you agree with the Apex Bank on this? These are my two questions. Thank you.
Okay, Chiwendo. We did not give projections on the exchange rate or on the reserve because we are living in a very volatile environment. We review our model on a daily basis as events unfold. If you observed, even today, it was reported that central bank spent another $150 million to support the exchange rate, the dollar. On 4th or 3rd of this month, they spent about $107 million. So these expenditures are eroding the reserve, and it depends on to what extent they are ready to fight to defend the Naira. If they pull back, Naira could see a major depreciation. Maybe in the region of 1,700 Naira, 1,750 Naira. We're actually projected Naira's worst level should be about 1,750 Naira. But all those things have actually been changed. All the assumptions have been affected by the trade war. Nobody knows how exactly the trade war will end. But my expectation is that Donald Trump will back down. And I think he's already backing down. If he backs down, the normalization will take a long time. The simple reason that he has actually jarred confidence of his closest trade partners. So they're going to build the economic model. Like today, election campaign is going on in Canada, and the campaign promise of most of the candidates is that they're going to decouple the Canadian economy from the US. They're going to reduce the impact of the US economy on the Canadian economy. And I think that's what will happen. If you remember one of the statements made by the incoming German chancellor, he said, he asked the European Union heads of government or leaders that do they trust Mr. Putin? And they all said no. He said, if they do not trust Mr. Putin, then we have to defend ourselves because the US government has thrown us under the bus. So, and immediately, Germany said they're going to spend about 200 billion euro to rebuild their military wares. And bear in mind that Germany has the technology. Similarly, I believe that Japan will also rebuild their military hardwares because they no longer rely on the US defense. So you're going to see an arms race. That all these things are because of the pronouncements made by Donald Trump. So because of the multiplicity of variables that are actually there in the air, we are not able to say specifically, but we are monitoring, which I said, people should keep in touch with their relationship managers, including myself. I'm also a relationship manager. And they will be giving you live updates on what we think will be the direction of exchange rate, the direction of interest rate, the direction of equity market, and every other tradable instrument that we're trading.
Okay, thank you very much, sir, for the answer. We'll call on Mr. Michael Ubona for his question. Please go ahead.
Has he not asked his question before?
No.
Thank you, Doctor, for the comprehensive work you have done. We really appreciate it. Well, Doctor, I want to ask, I like the confidence that Donald Trump will back down, but don't you think that this Trumpism is about China? Suppose he backs down in other countries, other allies countries like Mexico, Canada, and Europe. I know Africa is not in his equation, so, and leave China. If you leave China, what would that mean to the market?
Well, if he leaves China, which is the most likely thing, because if you look at the report I presented, I said their strongest or their greatest trade deficit is actually with China. What will happen is that the American economy has to go through some level of adjustment. Those adjustments will include that they have to move production away from China to a country like India, where he had actually announced a tariff of about 24%. And India also has the population also speak English and has relatively strong IT capabilities. The onshoring will take a longer time, which is the desire he wants to pursue. What that happen means that you're going to see increase in the cost of goods produced in America, because like I said, you're going to see a shift, a gradual shift. So it's not going to be like a light bulb effect where they just turn off on the switch and all goods produced in China will no longer enter the US market. The American market will still need some Chinese goods. And that means those goods will land in America at much higher cost, which will mean that household income will be impacted, inflation rate will go up in America, cost of production will increase if some of those goods are coming as input material, but most of them are coming as finished goods. So in terms of the Chinese economy will slow down because a large chunk of their export is going to US. China will try to develop alternative markets, but those markets will take a longer time to develop, like African market, other European markets, Middle East market, and they are not as big as the US market. So you're going to see a slowdown in China. Other thing that could happen is that China will automatically have excess production capacity, and we start a dumping process. We start selling goods at lower prices to other countries of the world. Goods that were originally meant for the US market that can no longer be absorbed by the US market because of higher costs in the US market or higher price in the US market will go to other countries. So you may see a decline in goods imported from China, which could disrupt other countries' production, particularly those who have production capacity. For a country like Nigeria, it could lead to a lower cost of imported items because they account for more than 25% of our total imports. That just to give some insight of could the multiple things could happen. There are a chain of events. Every economic variable have multiplier or multiple impact. I may not be able to mention all of them in one fell swoop.
Thank you, sir.
Thank you, sir. So we'll take another question from Richard Erikofe, and it says, is it likely, going by what you have projected, that prices of consumer goods will go down? Then another one from Boluwatife Phillips. What portion of the crude oil produced in Nigeria is exported, and what portion of these earnings is allocated to reserve? At what threshold of crude oil price decline will Nigeria be at a risk of complete capital flight?
Okay. Starting from what part of Nigeria's crude is exported and what portion is imported is retained. Bear in mind that we don't have a refinery in Nigeria other than the Dangote refinery. So the only portion that is refined in the country is whatever goes to Dangote refinery. The marginal refineries or the modular refineries are refining very inconsequential volumes. But the key thing we must bear in mind that most of our production is actually done by the international oil companies in offshore facilities, deep offshore facilities. And some of those production have been sold in forward trades. The ones accruable to the country, part of it has also been sold in forward deals, where the government had to pledge those productions for monies or loans that were obtained by government to sustain its operation. So in terms of free crude, which is what matters in our ability to manage ourselves. The free crude, the crude that had not been pledged. I do not have the figures exactly, but I don't think it's very strong. But as some of those forwards mature and they're not rolled over, then we'll be increasing our free crude. But the challenge that when crude production dropped, like we said, it had dropped to 1.4 million barrels. Is that free crude that is impacted? The other question is that at what crude price would Nigeria's economy be in jeopardy? Even at the current price of $65 per barrel, $65 per barrel, it's already a threat to our foreign exchange earnings. It's a trade. I had mentioned that our total export earnings 8% comes from crude, or crude and liquefied natural gas and gas export. So if these energy input material prices remain weak, the 19.6 trillion we are budgeting will be almost unachievable. And that will put the government revenue in jeopardy, government expenditure in jeopardy, and the government burden will increase. It could lead to some level of instability in macroeconomic environment, higher inflation rate, higher exchange rate, higher interest rate. These are the risks that we are exposed to. But all these things are projections and speculations based on how the trade war ends. We've seen some level of recovery in crude price, down from below $60 to now about $64. And today I checked the trading volumes here, remained relatively stable, oscillating between some level of 1 or 2% loss and gain. I don't know whether I missed any part of the question.
I think you've answered it perfectly. So we'll take another question from Samuel that says, subject to the ongoing trade war, do you think the future of global trade will shrink substantially? Then from Manji, Goff1 says, 2 questions. What will be the impact of it upon upgrade to the Nigerian economy specific to FX trade and FPI? What's your take on FX rates in Nigeria given the tariff war? Do you think CBN has the capacity to hold the rates down given the dwindling crude oil prices?
Okay, what I would say to Samuel is that the anchor of the global trade, which is World Trade Organization, is already in disarray. Because the US was the champion of World Trade Organization. US has basically thrown the World Trade Organization under the bus. Even China, that was always the one that was being dragged to the World Trade Organization, is the one that pushed for World Trade Organization. But once trade war starts and countries begin to retaliate, then it means that global trade will shrink significantly. This is what happens. Every country wants to be economically autonomous or production autonomous. And because the concept of world trade is based on comparative advantage, that you sell what you can produce more efficiently and import what you can produce more efficiently. When you begin to produce what you cannot produce more efficiently, then because the cost of that production will be higher on you, it imposes tax on your citizens, but it becomes the order of the day because the tariff that you have imposed on that country mean that those products that you're producing efficiently will still land at lower cost to your people. So certainly they wouldn't need to import from other countries that are producing it more efficiently. So it basically negates everything about global trade, and then global trade is likely going to shrink. I think Dr. Koji Wala said it could shrink by as much as 6%. Then the question by Fitch on by Manji, I think the Fitch report was, the data they used was based on the first quarter report. If you listen to my presentation, Nigeria's external conditions were shining in the first quarter of this year. And one was thinking, which is why we had to title this a new dawn or a circus. Everything about the first quarter of this year indicated a new dawn, which is what Fitch used to make their projections and also improve their rating. But bear in mind that ratings are reviewed regularly, just the way we are reviewing our recommendation list and our outlook. So I believe the changes that has happened in the world economy since the 2nd of April could force any rating agency to review its position. The JP Morgan report is more contemporary, given that it was based on the changes in the global economy post Freedom Day. Then whether the CBN has the capacity to hold the rate down, I think I've spoken on that. If crude prices collapse or remain at sub $65, then that is $10 share of our target. And bear in mind that our crude production is also 600,000 barrels share of our target. So it may be difficult for us to earn enough reserve, enough foreign exchange earnings to sustain exchange rate. But having said that, the central bank has done a great job using monetary tools, yield on OMO, yield on treasury bills instrument to sustain foreign portfolio investors' interest in the economy. But let's hope that the trade war does not degenerate to the point that foreign investors will all leave emerging economies, including the Nigerian economy. So a lot will depend on what happens in the global economy.
Okay, thank you very much, sir. We have a question from Daniel. Do we expect some policies adjustments on the fiscal and monetary policy to stabilize our economy, since some external forces and policies can disrupt our local policy? And given our policy somersault government hands, how do we, being the second biggest economy in Nigeria, stay economically stable, chart FDI and FPI? And another question from Ahmed Yaro. He said, thank you, Dr. Highly detailed and informative. About budget benchmark at 75 DPP and price of crude at below 60, what should government do to meet budget targets and plan?
Okay, starting from Daniel's question, the appropriate thing is for government to adjust its fiscal plan. We had actually cried ourselves hawks that the fiscal plan was overly optimistic and was not realistically achievable. But now with this Donald Trump's tariff war that has brought down the crude price and our own internal contradictions that has also led to a lowering of crude production, the most appropriate thing is adjust the budget provisions and make it more realistic so that we don't end up borrowing a lot more, weakening our fiscal conditions, increasing our debt burden, increasing debt service obligations, and possibly injecting a high-powered money into the economy that could further worsen inflation rate and exchange rate pressures. So, I expect that the government will need to take measures to realign our fiscal framework with the realities on the ground. I think the next question he said is from who? Ahmed Yaro?
Yes.
Okay, his question at budget benchmark at $75 and price of crude at below 60. What should government do to meet budget targets and plans? It's nearly almost impossible for government to meet the budget plan. Bear in mind that the government had projected 22 trillion naira from oil revenue and 19.6 trillion naira from oil revenue. But even the 22.6 trillion naira or 22.4 trillion naira partly is indirectly derived from oil activities. Importation will slow down if exchange rate devalues or government can't fund it. So custom duty tariff will reduce, MPA charges will reduce, corporate taxes will reduce if corporates are no longer making so much profit. So the most appropriate thing is to adjust the budget, modify the budget to be more fit for purpose, to focus on priorities. In terms of other areas, unfortunately, we are not strongly been attracting foreign direct investment. Is the foreign direct investment that we should use to mitigate some of the pressures on forex, because short-term money will slow down, and even if it comes, its exit will be very swift. The other thing the government can do is to look at, it has a provision about 22 trillion naira on capital expenditure, which, like I said, it would be difficult to achieve. So the government can actually review some of the projects it had meant to fund from budgetary allocation to outsource them to private sector investors to fund under the public-private partnership arrangement. And that way, we'll still bring in the capital, bring in the infrastructure without burdening the government with higher debt and interest services.
Okay, we'll take another question from Chukwuka Opara. What is the short-term, medium, and long-term exchange rate outlook in Nigeria? What's the best short-term and mid-term investment securities? I know you've touched on this earlier on. Another question from George that says, thanks for an insightful presentation. Please clarify the massive turnaround in Nigerians' EOP. Any trends?
Well, the balance of payment, we are driven by two things. I had mentioned that we had a 16 trillion naira positive balance of trade, which flushed into the balance of payment. And then you have on the current account, we also had a positive. And then on the current account was driven largely by sale of federal government debt instruments, bonds, Euro bonds. Then you had sale of treasury bills and what do you call it, OMO. Last year, total sale of OMO, treasury bills, and federal government bond, as well as federal government's savings bond, was about 31 trillion naira last year. Part of those investments were subscribed by foreign portfolio investors. We also saw an improvement in the home remittances, diaspora remittances last year. All this inflows into the balance of payment, positive balance of payment we saw last year. Is it a trend? Yes, to some extent. There's been a consistent improvement in domestic home remittances or domestic remittances for Nigerians in diaspora. It's likely going to continue. The balance of trade could come under jeopardy if crude prices drop or if crude production drop as well. So what can be sustained, what looks like is sustainable, seem to be the domestic remittances. The uninvisible, we had a negative because of capital repatriation of arrears of capital that we are still trapped in the economy that had to be honored by the central bank. But the key thing, if you disaggregate the balance of payment, there's a threat on the positive trade balance. The only thing that you have going for the trade balance that may make it difficult not to turn negative is because demand, local demand is also weak. You realize that Nigerians do not have the strong purchasing power, and therefore the demand by Nigerians for import, which is why we saw a 60 trillion in import against a 76 trillion in exports, or 77 trillion in exports. So demand is also weak and could be weakened further if exchange rate devalue or if inflation moves northwards.
We'll take another question from Ahmed. Okay, I think he has asked the question before. Just give opportunity to others to ask. Anonymous says, is there a reason why Zenith Bank is not in your list of recommended stocks to buy at this time? And then we have saying that the US sees a 50 BP of crude oil sustainable for the economy. How best can Nigerian economy strive aside getting more loans? What is the second question? What is the fate of CBN/Nigerian banks who issues US-nominated bonds where there is a slow but gradual disposal of the US Treasury assets by developed countries?
Okay, the Zenith Bank, why Zenith Bank is not on our recommendation list as at now is because of the price at which it's trading. So we look at what are the upside potentials and downside risk before we recommend any stock. So the price at which the stock is trading and what we think is the upside potential and downside risk at that point may make a stock not to be recommended for immediate purchase, which is why I said that we review this recommendation list on a daily basis. So if the price corrects to a certain level, it will make an entry point price for us to recommend it. So that's that, but not that we consider Zenith a fundamentally strong stock. We consider Zenith as a fundamentally strong stock. On the $50 per barrel crude Sorry, my communication was lost at some point. I don't know whether you can hear me again.
Yes, I can hear you, sir.
Okay. Okay, so I was saying that the $50 crude, the US had actually has exited the climate group, the Paris Club, on the basis that it wants to encourage production of hydraulic fracturing, production of crude from hydraulic fracturing, which it believes it has a lot of crude underground, and that with that, it will bring down crude price. But it takes a longer time than that, or a weaker economy to have a $50 crude. What can Nigeria do? We need to intentionally begin the diversification of our economy into a productive economy. We need to do the right investment in infrastructure. And unfortunately, we don't have the headroom now to do that. Public-private partnership arrangements. As a country, we still enjoy those infrastructure. The government does not need to pay taxes. All we just need is allow the investors to recoup their investment over time. But it's not a good time for Nigeria, depending on how the trade war plays out. But having said that, we need as a country to start the process of building the infrastructure that will make us a productive economy. And I like using this example. Vietnam, the US government imposed, and if you saw the presentation I made, you saw Vietnam is one of the countries that enjoy huge balance of, positive balance of trade with the US, or US is suffering deficit balance of trade. Cast your mind back, depending on how old you are. If you're up to 50 or close to 50, you wouldn't have heard about Vietnam War, Vietcong. When we were young, we were used to watch films of Vietnam War and Vietnam and US soldiers fighting. Vietnam was in a worse situation than Nigeria, but Vietnam has turned into a manufacturing base because of what they intentionally did to build infrastructure and attract manufacturing from US. If you are wearing a Nike shoe or a Nike cloth, it is likely it was made in Vietnam. If you go to any major shop in UK, US, you're likely going to buy things made in Vietnam by American companies. That's where we should be. We have the population. We are closer to Europe than any of the Asian countries. So if we turn ourselves into a manufacturing base, even if it's contract manufacturing, we are likely going to attract the investment that we desire to make the country a more stable and to reduce the vulnerability of the economy from external shocks.
Okay. Thank you very much, sir. So we would pick a question from Dr. Izzy. Sir, please, are there any official explanation as to why Nigeria's crude oil production declined in the last 2 months? Will the current level of oil production and price significantly impact fiscal and monetary policy decision in short term?
Well, I think they said the federal government had actually reported that the trans Nigeria pipeline was breached. I don't know how true it is, and they said so. There was clearly some level of shorting during the period under in reference, particularly in the Niger Delta region. I think in Rivers State there was a shorting. I think there was also some shorting around Bayelsa from ITO production. So that those two could account for that drop in crude production.
Okay,
So
we'll take
the second part of here the second part of with the current level of oil production and price significantly impact. Clearly, I think I've emphasized that at 4.4 million barrels, when you had planned 2 million barrels, at $64 when you had planned for $75, those are two negative variances, both price variance and volume variance, and certainly will affect any budget.
Okay. We'll talk another question from Malu. It says, very good presentation. Given the falling level of external reserves and weak nature of Naira, I see that the supposed positive initial outlook was more monetary in outlook than real. The focus on the real sector seemed to be weak and not in focus. Essentially, do we have a circus? Do you agree?
That's the question.
Yes.
We had said, because one of the things we said that, look, we started well, we saw a shining external sector, we saw stability in exchange rate, we saw stability improvement in reserve, we saw reduction in inflation rate, and we thought that it was spring, that we're approaching a spring, and then only for the harmattan to hit us. So it then means that we are going to go the same cycle again: depreciation of local currency, loss of reserve, inflation rate, which was a cycle. So we keep going in a cycle and then repeating the whole process until we reduce the vulnerabilities of the economy. It's when we reduce that we will eliminate this circuitous movement.
Okay, I have anonymous here that says, which sector should investors focus on? What is your view on insurance sector recapitalization? Then another one from Chiwendo. This is Chiwendo from Daily Sun. The CBN has insisted that Nigeria needs FDIs and how stated that recapitalization must go despite Trump's sweeping tariffs. What's your take on this?
Okay, which sectors should we focus on? I think we highlighted the sector, agriculture sector. I don't think you can go wrong there. If you're looking at sectors for investment purposes, agriculture sector, we mentioned that the banking sector will still remain a bellwether sector. So those two sectors, we are strong with those sectors. We are not very strong on the oil and gas sector. The industrial goods sector, not too strong. The insurance sector will present opportunities when after the recapitalization. So we were very detailed in the sectors we think people should invest in. But we also need to emphasize that these sectors are very fluid because the macroeconomic environment is also very fluid. So anybody, you just need to keep in touch with your advisor in Cowley to keep updating you on changes in the macroeconomic environment.
Okay, so Tawfiq Akolade wants to know, sir, thank you for your contribution to financial service and Nigerian economy. What are the expectations on equities and fixed income markets in Q2 of 2025? Then
I guess I'm not repeating myself on the equities market.
yes, then a lot of the questions are similar actually. So the question from Franklin that says, thank you for your presentation. I want to find out the effect of multiple borrowing the government is borrowing on our fragile economy.
Well, the implication is that we're witnessing an increase in debt service. We've seen the national debt go to 144 trillion. So we are increasing. When you have an increase in debt service, it crowds out the government's ability to invest in other critical sectors of the economy. And it creates some level of macroeconomic stability because government borrowing crowds out the private sector, increases interest rate increases the cost of doing business in the country and slows down real sector productive activities.
Just to let our guests know that please, you're allowed to raise up your hand if you want to ask live questions. I would take a question from Kelvin Okoro. Can you advise a combination of investment portfolio that can match or edge against current inflation rates in the medium to long term? I think we would have to reach out to you after this webinar.
I hope they have access to us in terms of our Twitter handle, our email address, so that just in case you need to reach out to us, or if you don't have a relationship officer, you need to quote for them the numbers they can call. so that in case they need to reach out to us, so that for those who don't have a relation with us, and we will assign a relationship manager to always guide in your investment objectives.
Okay, so we'll do just that. We'll also take a question from Kehinde Oyeleke. Do you see the current global uncertainty as potential beneficial or harmful to the emerging economies like Nigeria?
Well, they are certainly harmful to the emerging economies, particularly countries that don't have a productive base. If you have a productive base like India, you can take advantage of the tariff. If you look at the tariff on African economies, apart from the country like Mauritius that had high tariff, most African economies were a slap on the wrist. Ghana was about 10%, Nigeria about, I think Ghana 12%, Nigeria 14%, Cameroon about 12%. So you've realized that most, or some of them actually, Egypt will have 10%. Most African economies, apart from South Africa as well, that the Trump government already have issues to grind with. Most African economies had very low tariff. Bear in mind that a country like India that got 24% tariff is wooing manufacturers in Vietnam that was slammed with the 47% tariff to come to India across the border and come and produce in India and pay 24% tariff to export to US, because Vietnam, the US government imposed 47% tariff on them. Assuming we have a productive base and we can produce at cost competitive levels, and our tariff is only 14%, it then means that we can actually outcompete India in terms of wooing US manufacturers to come and produce here and export at 14% to US. So, but unfortunately, we don't have that base, so we can't take advantage of this opportunity. We are rather stuck with the negatives that could be a fallout of this issue, this trade war. I think Dr. Bayo Lubemi's hand is raised.
Yes, I wanted to invite him. I would like to call Dr. Bayo. Please go ahead and ask the question, sir.
Thank you very much. I had them calling you Dr. Dr. Johnson.
What to force me to go and read a degree?
You have not watched it, so I hope you will watch it very soon. Thank you very much for the insightful analysis. You said often and often again the issue of infrastructural development and the inability of our government to fund them with our current state of economy and revenue. You agree with me that power sector will be a key factor when we talk of infrastructure development, and we've been having issues with it over the years. So what do you think this government should do urgently about the power sector? Thank you.
Okay, thank you, Dr. Bayo. The first thing, if you look at the weakest link in the power sector, is the transmission grid. And the government had actually said that there was no investment in the transmission grid for the past 10 years. I think the government should privatize the transmission grid, bring in private sector, break it into regions, so we don't have the highly concentrated transmission grid that makes to a national power failure. So if you segment, if we break the transmission grid into regions, so you have the western, the eastern, the northern, or north central, and we have a distributed the transmission grid, and then you can concession those grids to private sector investors to strengthen the grid, improve the capacity of the grid. If we do that, we're likely going to see for higher capacity to wheel out power, and then it becomes that each region can sell power to the other regions. They are connected, but they're largely semi-autonomous. So that's the starting point. Private sector have to come into the transmission grid. On the distribution network, where the government actually has used the banks to take over most of the, I think apart from 2 or 3 of them, the rest are under the government control or the bank's control. It's only Eco Disco, Ikeja Disco, and the Enugu Disco that are Okay, yeah, Eko Disco, and then Enugu Disco that are still under the private owners. So what the government needs to do for those that have been acquired or retaken by government, they need to issue golden shares to new investors. And those investors must be pre-qualified based on their capacity in terms of technical competence as well as financial competence. The primary objective, which was one of the criteria for the concessioning or this the pre-qualification of the DISCO investors, was reduction in aggregate technical collection and commercial losses. It was never enforced. If you want to enforce the reduction in aggregate technical commercial and collection losses, you need to improve the distribution grid. I think government is also trying to bring in transformers, that distribution transformers to bring that. But the key thing is that the ownership structure have to be modified, both the transmission grid and the distribution company, the DISCOs. For lucky, you're muted in case you're trying to speak.
Thank you, sir. Okay, so
Dr. Pai, I hope that answers your question. Okay, maybe he's muted.
yes, he's just trying to talk. Okay, I think we should take a few more questions. Is that okay by you?
Yeah, go ahead.
Okay. So, Anonymous has asked, with the rebased inflation at 25% and current MPR at 27.75, do you think we may see a drop in borrowing rate at next MPC meeting?
You know, interestingly, we were already seeing a decline in interest rate towards the end of first quarter, which I had highlighted in my presentation. We saw a constant decline in interest rate, which was supposed to signpost a review of the monetary policy rate to a lower rate, or a reduction in that liquidity ratio or cash reserve ratio, particularly cash reserve ratio, which is one of the most punitive ratios that the banks are suffering. But unfortunately, a lot of things have changed. The macroeconomic environment prior to the Freedom Day is completely different from what it is today. So I think it will not be most suspicious for the Central Bank Monetary Policy Committee to adjust it now when you have so much undefined uncertainty. The most likely they would do, but bear in mind their next meeting is May. So hopefully by the time we get to May, there will be more clarity. But in case the situation remains as woolly as it is today, they are likely not going to adjust rates.
Okay, I'll take the last question from Eriko Faye. How come the banks are all declaring such mega profits when the whole economy seems to be crumbling? Are they really engaged in banking services, I believe?
Well, if we disaggregate the bank's income, you will realize that the banks are getting the benefit of heightened return on fixed income instruments. We have talked about last year, we saw Treasury bill 364-day bills at high as 22.6%. That was the discount rate, which gives you effective yield of close to 28%. And the banks did not really have any material increase in their cost of funds. Some of them had some level of increase in their cost of funds, but they had opportunities to invest in risk-free assets at rates that were quite high. Also, bear in mind that the asymmetric corridor was changed from plus 200 minus 300 to plus 100, plus 100 minus 500 to 300 to plus 100 minus 500, to plus 500 minus 100 at an NPL rate of 27.5%. It then means the bank can also place money with the central bank at 26.5%, which was far above the cost of funds to them. And then you also seeing a higher level of transaction volume, with the banks are benefiting from using alternative service delivery channels. So you see their commissions and fees have also increased and the cost of servicing the customers are also reducing for most banks, apart from one or two banks that we saw a material increase in their cost to revenue ratio. So for those banks that have kept their lead on their cost to revenue ratio, because they don't need to open branches for you to do your businesses. So they're enjoying benefits of use of technology to provide service at lower cost. They're enjoying increased net interest margin from their investment in treasury bills instruments, and their lending cost price is also very high at about 30-35%. So these are the reasons why the banks make good money, added to exchange gains that they made from their investments or in foreign currency instrument, which the central bank had actually told them to exceed their open position.
Okay, so we have two hands up. I would call on Mr. Osimhen to ask his question. Please unmute and ask your question.
Thank you very much. So this for Dr. Johnson. I want to ask, I love your presentation, excellent. However, it stayed silent on the healthcare space, right? And also in extension, the hospitality space in terms of investments. I know a lot of investors in the healthcare space, like the Evercares and Reddingtons and the Dodgers, most of them, they get funding through private capital. But just asking, right? What are the potentials in terms of yield in the healthcare industry? How can it go further? Because we are gradually seeing an increase of reverse procedures being done in Nigeria because of the wait time abroad in the US and the UK, but rather coming back to have the surgery. And the potential is quite huge, if you ask me. Thank you very much, sir.
Thank you, Osemhe. The potential for the tertiary healthcare services, particularly from the private sector perspective, is quite strong. And I'm quite conscious of choosing my words. Tertiary healthcare services. So we are talking of the likes of where you have to do complex procedures. The public sector medical institutions, because of the lackadaisical administrative issues around the public sector institutions, are not attractive to Nigerian, to diaspora or medical tourists coming to Nigeria. So they are limited to the private sector driven health facilities. But there are also challenges with those facilities. We've seen a lot of migration of the most competent people out of the country. So if you go to some of those facilities, you will see a dearth of competencies. But having said that, if the homebound medical tourism increases, you're going to see a return of those expatriates, Nigerian expatriates in other countries, because the cost of living here is still cheaper. They will earn income that is relatively commensurate with what they earn elsewhere in the world. And those institutions are clustered around Lagos. So I think there are strong opportunities for tertiary medical services, particularly what you mentioned, the National Health, National Health Fund, what they call it in the UK. It's going through a major difficulty. The government is trying to modify it because like we said, the waiting time is so long, and people who have life-threatening procedures may not have to be able to wait. People who have the means may not be able to wait. So we are seeing a lot of those people come back to Nigeria to carry out their procedures. We have a few of those hospitals that can meet those standards. But then the challenge will still remain in expanding their capacity. Capacity expansion will be constrained by one, the number of competent medical practitioners, two, funding. But having said that, on a balance, I think they present good opportunities.
Okay, so on the hands of Mr. Edwin, please go ahead. Probably the last question. Akuma, please.
Okay, good afternoon, sir. Most grateful for this very insightful and interesting presentation. Even though I came in at the middle of the presentation, I have gained quite a lot in the happenings in the economy. My question is this: when dividends are paid in the stock market, why is it that that amount, the exact amount of paid dividend, is being reduced from the cost of the stock almost immediately? I don't know, how does it work? Because that aspect always confuses me, and I need to be properly guided in respect of that.
Okay. Thank you, Mr. Edwin Wokoma. Okay, what they do when you buy stock before the payment of dividend, what they call a markdown. The markdown is the date where if you buy that stock, you will not get that dividend. So when you buy a stock today, and the stock had declared a dividend of 5 naira, so the price that you will buy the stock includes that 5 naira, okay, which you will receive. The day that dividend, that stock is marked down, it will be, anybody who bought that stock after that day will not get that dividend. So they will subtract that amount of dividend, because those who bought that stock that after that markdown will no longer get that dividend. So after that, the price will now find a new level, either go up or come down. So that what they basically do is that, because when you are buying cum div, cumulative of dividend. When they say it's cum div, it simply means cumulative of dividend. It includes dividend. So if you buy cum div before the markdown, you will get that dividend. Take, for instance, you are buying, let's assume Fidelity, which they have not paid the dividend. I think it's still trading cum div. They have declared dividend of 125 kobo. You did not own the share when they declared it. You buy the share today, you were buying inclusive of that dividend, which you get the day they pay it. So the day they said, look, from this date, if you buy this stock, you can no longer get dividend. That's the day they close their book. So they will reduce the price by that amount of dividend, which 1.25 kobo, because anybody who buys that day can't get that dividend. So that's that's what happens. I don't know whether this explains it to you.
Okay, I understand now. Yeah, but why should it be so? So that means I have virtually not gained anything by buying that stock.
It is so, because when you buy, the reason why you are buying today, because you are looking at that money. That's what most people would do. So you are buying today because you are getting it. The day you get that money, the price will reduce by that money you have received that day, because the value you bought today, if you buy Fidelity as 18 naira today, for instance, that 18 naira you are paying because you expect to get 125 kobo dividend. So when you get that 125 kobo dividend, the price will drop to 16 naira 75 kobo, because you have collected part of that price you paid for the shares. So that's what happens.
Okay, from another perspective, assuming I had that share in January, and they are declaring their dividend in June, or perhaps in where most of the banks are doing it within this period in April, it means that they are paying me what I am supposed to have earned on the stock market, because the price may have gone to 19 naira. So when they pay the dividend now, they now reduce it by 1 naira 20 kobo, which is 18 naira 80 kobo. So my share now drops to that. And I bought in January without perhaps looking at capital appreciation to sell, or perhaps not looking at dividend. So what do you have to say about that, my perspective?
Okay, if you bought in January, for instance, you may have bought the stock at a price that is not even at the current price. This is what happens when people expect that the company will declare dividend, the price start going up. People will factor in the expectation of dividend. So, and that is why the price will move up to adjust for that expectation of dividend. So if you bought much earlier, if you buy right, if you have a good advisor, you wouldn't have bought at the current price. But when people think, this company like GT declares 7 naira dividend, when people think, GT is they will look at third quarter results. When they see third quarter results, they say, okay, they will begin to project what the income will be and what dividend will be. So they factor in the possibility of dividend. So when they declare that, people once they declare dividend, you see price move up quickly to cover that amount that they declared. And that's why people who are buying to collect that money. So when that money is paid, that money is reduced from the price the market regulator adjusts the market. Otherwise, if you buy, when people have collected money, for instance, if you buy Fidelity at 18 naira today and you collect dividend tomorrow, nobody will be willing to buy it at 18 naira because they won't get another dividend immediately.
Thank you, sir.
Okay.
For your clear explanation. Okay, I can feel that Dr. Violet is still up. I want to confirm, sir, do you want to ask another question or you want to contribute?
Thank you very much. I just want to contribute. I think Mr. Wokoma, this is very simple. Though Dr. Johnson has explained, but let me also explain that you know that most of the companies declaring dividends now, their year end was actually December 31st. Okay, so take that into consideration. And you are buying now. If I was a shareholder as at 31st and I'm selling before the dividend, I've lost. I won't collect the dividend. But you are collecting the dividend. We just bought a day to the closure or even 2 days or a day to the closure. So now put yourself in my shoe and now put yourself in the shoe of somebody who is buying after closure. And that person starts to buy at 19 naira, for example, 19 naira 20 kobo, and the company is paying 1 naira 20 kobo. If today is the closing date, I bought yesterday, I'm going to get dividend of 1 naira 20 kobo. Somebody who sold 2 days ago at whatever price will not get that dividend. So if I'm buying tomorrow after the closure or 2 days after the closure, I should not buy at the price the person who bought before the closure is buying. So that is the reason why, to bring everybody to equilibrium, when dividend is declared, you mark down the price by that amount being declared. So that if I buy tomorrow, I'm on the same level with you. And the price can start going up almost immediately or going down, depending on the matrix of the economic situation of that company and the country. I believe that should explain it more. You are just bringing everybody to equilibrium, to the same position. Okay? No cheating. Thank you.
Thank you, Dr. Bayer, for weighing in.
Thank you, Dr. Bayo, and thank you, Dr. Chuku. Thank you for your thoughtful and enlightening responses. Your insights have truly added dirt in today's conversation and also sparked important reflections on where the Nigerian economy is headed. Thank you, everyone. Thanks to everyone who joined us today. Thank you for your time, your questions, and your participation. So your participation has been what made this session very meaningful and impactful. We hope that when you're walking away with a better grasp of opportunities and challenges ahead, and that you feel more empowered to make more informed decisions in 2025. So as we wrap up, we would love to hear your feedback, what stood out most for you today. So you can feel free to drop your thoughts in our chat or email us at info@carryasset.com. Also, don't forget that the full recording of today's webinar will be available on YouTube channel, that's Carry Asset YouTube channel, and slides to be shared with all registered participants. Also, follow us on all our social media platforms to stay updated on upcoming events, insights, and investment opportunities. Our next session will come up in Q2 of 2025, and we'll be absolutely delighted to have you join us again. Thank you once more for being a part of today's conversation. Stay safe and stay informed from all of us at Cowrie Asset Management. Have a wonderful day. We also want to quickly state that please, you can follow us on Cowrie Asset Management for more insightful content and investment audits. You can feel free to join us on our social media pages, Twitter, Instagram, Facebook, or you can email us at info@carryasset.com, or you visit our website at www.carryasset.com. You can also call this number 091-370-48686. I'll call that again, 091 37048689 for questions, inquiries on our products, services, or you want to have a relationship manager dedicated to you to give you insights on market trends. Please feel free to call that number. Thank you very much, our esteemed speaker, Mr. Johnson Chiku, for sharing your wealth of knowledge to us. Thank you all. God bless.
Thank you all.